Good morning and welcome everybody to the second in our webinar series of incorporating global equities into managed account portfolios, international equities in the current global market. Today, it's my pleasure to introduce Nathan Lim, Head of Portfolio Research at Morgan Stanley Wealth Management, who'll be the moderator today for our two presenters, Monik Kotecha of Insync and Francyne of Franklin Templeton. Before I hand over to Nathan, let me just talk a little about the third in the series of webinars. Next Friday at 12 o'clock, we'll have Mark Arnold from Hyperion, Tom King from Monik Asset Management, and Lachlan Hughes from Swell Asset Management, talking about the joys of stock picking from Australia in global equity markets. Both Hyperion and Swell have a particular strength in running managed account portfolios in global equities. So join us on Friday for that session. Through the course of this session, if you have a question, use the Q&A button at the bottom of your screen. Our presenters will see that and be able to deal with it as we go through the session. Now it's my pleasure to hand over to Nathan Lim, who will act as our moderator for today. Nathan, thanks very much and welcome.
Hey Toby, great to be here again. Hi everybody. Thanks for joining this session being hosted by the IMAP Association. As you heard earlier, this is part of a series. On Monday, we were talking about the practical considerations of international investing when you're using SMAs. The second and third, really starting to get into the minutiae of investing overseas. Today's session is really focusing on the macro. And as Toby mentioned, we've got two speakers today. We've got Monik Kotecha from Insync Funds Management and Francyne from Franklin. Let me just say a few words on each of them. First of all, for Monik, Insync Funds Management, they were awarded the Emerging Fund Manager of the Year in this year, 2020, by Money Management. Monik is the Chief Investment Officer and has been a 30-year veteran of the funds management industry, both locally and overseas. This includes 7 years as a senior PM at Investors Mutual, 5 years with BT Funds Management, and 3 years with the Abu Dhabi Investment Authority. While in Investors Mutual, the team was awarded Fund Manager of the Year for the Australian Equities category in both 2002 and 2003 by Money Management. Francyne, she joins us. She's a PM with Franklin Equity Group. Before joining Franklin in 2008, she was a senior investment manager at Picta Asset Management and a vice president at Citigroup Asset Management covering financials. She has a BA in BCom from the University of Melbourne, and is a CFA. I would add that also Franklin was the winner this year in the international equities category of the IMAPS award. So what we're going to do with today's format is that we're going to let each of our speakers speak for about 5 minutes, just sort of to provide a background on how they think about the world, their sort of investment approach. We're then going to turn to the 6 key questions that I think some of you would have seen already in the invitation, and let each of them have an opportunity to answer the question before we open up the Q&A. I would encourage you to keep submitting questions throughout the session, and we'll try to answer as many of them as we can as time permits. So with that, I'm going to pass over first to Monik to talk about how Insync Funds Management goes through their investment approach.
Thank you, Nathan, and welcome everybody today. It's an absolute pleasure to be part of the panel discussion. So just by way of introduction to Insync, we're a specialist global equity manager. And our focus is really very much on investing in the most profitable companies out there that have a really long runway of growth, benefiting, which really comes from global megatrends. And megatrends are very large, they're very durable, they're almost unstoppable and on the right side of disruption. So when one thinks about the aging population or the move to the cashless society, or the drive towards improving health and fitness, with COVID, that drives very much in place. Those trends are going to be very large and they're not impacted by economic cycles. As a global equity manager, we do look at factors both on a top-down and bottom-up basis to develop a structural framework when we're thinking about how to structure an investment portfolio. So what this chart shows here from a top-down perspective is that we've been in a sustained period of low growth and low inflation. So, central bankers have thrown really the kitchen sink at the economy to try and accelerate the growth rate since the GFC, and have had very minimal success over the past 11 years. Now, if you look at bottom up, which is what we do, we look at a lot of companies, sectors, and industries. Our analysis shows that the significant pace of disruption is really accelerating and impacting every single company and sector out there. And the outcome of that is that a lot of businesses are really struggling to grow their top line and have lost their pricing power. So there is a real high degree of consistency between what we're seeing from these top-down data coming through and the bottom-up analysis. If you can go to the next slide, please. So in this structurally low growth environment, we strongly believe that investing in megatrends really provides a greater level of certainty in a really uncertain environment. We invest in 30 highly profitable companies right across these 16 global megatrends. I think one of the things you may observe when you look through this is there's a lot of non-tech within our megatrend exposure. When people think about disruption, they think about technology, where there's a lot of non-tech sectors that are benefiting from megatrends and disruption. And this provides our investors with a high level of diversification benefits. So really identifying megatrends, evaluating its potential size over the next 10 years, finding the most profitable businesses and correctly valuing these what we think are the future winners is really what we consider to be our competitive edge. So if you can go to the next slide, please. You can see here that this is the performance of the two funds that we're currently managing, the two managed funds. They're both identically managed. They've both got the 30 stocks across the 16 global megatrends. There's only one difference between the two funds. The Capital Aware Fund has an added downside protection strategy in place. So you can see that in a very difficult environment, the megatrends are delivering returns. What's really attractive from our perspective is that, if you think about COVID, the portfolio actually fell significantly less than the market during that tumultuous period in February and March. And when the market recovery came back, because we're tied to those megatrends, and those megatrends are growing faster than global GDP, we actually picked up more than the market recovery when it came back. So really attractive features to have in the portfolio. And perhaps a final word here to say is, we've been working on MDAs and SMAs for quite a period of time, and we've we partner with advisors to do so. We've had an excellent relationship with Crystal Wealth Partners really over the last 8 years, and really built up a lot of experience and a really strong track record in managing portfolios in a similar structure. So with that, thank you, Nathan. And yeah.
Thanks, Monik. That's a great introduction on Insync and your approach focusing on disruption. With that, I'm going to pass over to Francyne. Thanks for joining us today, and just give us a few minutes on how you guys look at the world.
Thanks, Nathan, and thanks everyone for the opportunity today. I work with the Franklin Global Growth team as a portfolio manager, and the team manages around 12 billion Australian dollars in AUM. We actually like to think of ourselves as a boutique under the umbrella of the Franklin Templeton Group, which is a global asset manager with 2 trillion in AUM. And we're fortunate enough to have the support of a strong corporation which provides, strong, good operational functions, which allows us as a team to focus solely on investments, which is what we do best. So as part of the Franklin Global Growth team, our investment strategy, I think, which is on the next slide, thank you, is the following. We run a bottom-up research-driven strategy with a concentrated portfolio. It's 35 to 40 names in the fund, or 20 in the SMA. We're benchmark indifferent. We have a long-term investment horizon of 3 to 5 years. The average holding period is around 4+ years, although we have quite a few names in the portfolio that we've held for longer than that. And then one of the key things in terms of our risk management is that we seek to manage risk by limiting the economic overlap among our holdings, so that really we're selecting companies which, earnings do not correlate, are not highly correlated with each other. And so it provides diversification across the portfolio. So, if one name falls, you're not sort of seeing a cascading effect across the portfolio. And this has been, obviously helpful in the most recent times during COVID, where, you've seen the consumer facing names, given that they've had to close down and lock down in the, given the lockdown of economies, they haven't been able to sort of earn revenues. Those names have been sold off aggressively. And, on the other side of that, we've got names in the portfolio which have benefited quite strongly in terms of, so cybersecurity and, e-commerce, which has seen increasing adoption. Lastly, our opportunity set is global. We can search without borders. We can hold up to 20% in emerging markets, but typically we've averaged less than 10% in the portfolio. So the next slide, we're trying to capture here that we have a differentiated strategy. You can see this in the style chart. We tend to play lower down in the market cap spectrum, and tend to find names which are, are earlier in their growth phase, and as a result of that present, higher sort of sustainable growth over the long term. We're really trying to sort of find names that can grow with the portfolio over time. We tend to like businesses with 1 to 2, to 3 lines of business, such that we can really see, management execution upon the strategies that they sort of provide. Put another way, on the next slide, we have very high active share, and 2/3 of the portfolio is invested in market cap names of less than 50 billion. You can see across, across our competitor set, many of the names have, holdings in the FANGs, and a lot of them, have all of them, I suppose, in their portfolios. What we're really trying to do is to sort of be active in terms of, the management of the portfolio. And our, cross holdings with our other competitors is one name, Visa, in the top 10. And so, we're really looking, in terms of the fact that we're sort of playing down the market cap spectrum, we really do think that we provide good diversification across, other international managers out there. So I think that's really just a snapshot of what we do. We're really trying to, find names that can provide good growth, in a portfolio over the long term. We're finding names with that generate strong free cash flow, good competitive advantage, and that can grow with us over time. And that's resulted in fairly consistent performance over time. And you can sort of look at that slide going, at your will. But the name of the game is really to sort of provide alpha over the long term. Thanks, Nathan.
Thanks, Francyne. That's actually great from both of you. I think I can appreciate just looking at your respective track records. Both of them are quite impressive. That what you're doing works, and the focus on risk is definitely a big selling point in my mind. And also this idea of that you guys are looking for a diversification of returns is quite important. So with that, let's dive now into sort of like the meat of today's presentation, which is really start looking at sort of the macro environment. And we are literally just days away from probably the biggest macro event that's going to happen in 2020. I'm not talking about more COVID news, but the US presidential elections in particular. And so first of all, I'm going to turn to Monik first. What do you think are the implications of the coming US elections? Win, lose, draw. How are you guys positioning for it, or what are you guys thinking about?
Thanks, Nathan. So if you can go to that next slide, please. I've just got the one slide here. which is worth looking at. And you know, there's always volatility going into an election. You know, there's always a great level of uncertainty. And as you pointed out, Nathan, this year is probably a lot higher. A lot more people are viewing it. My children are interested and debating and talking about it, which is really unusual because they don't talk about politics generally. So I find that quite amazing. But what this chart really shows is that if you made your major investment decisions based on the outcomes of the US election, then you're probably going to be hurting your portfolio, because regardless of whoever's in power, the returns in the ensuing years continue to be quite strong, consistent with the history of stock markets, right? So you know, I think that's a really important to make right up front. And interestingly, even over the 12-month period, once the election's out the way, the markets are typically up for the 12-month period as well. So, you know, in our opinion, it's quite dangerous to try and time these things. Now, there has been a period where the market has been down, which is obviously during, I think it was 2000, when there was, you know, we had to wait a couple of months before the election results were actually resolved. But apart from that period, it's been fairly consistent. The other interesting fact I like to sort of just share with you is that there's obviously a lot of polling going on at the moment suggesting that Biden's going to win by a significant margin. But the stock market historically actually has been a very good indicator, particularly in the last 3 months leading up to the election. So, you know, the markets have been strong in that period. The incumbent has typically won. So I'm not going to say it's not going to be different this time around, but there's a lot of factors at play, and I think that's what I'd like to share with you. Obviously, I think the more important thing to understand is to try and appreciate what are the respective policies and what it means for the individual sectors. And I think we all understand where Trump sits today, so I don't think we need to spend necessarily a lot of time on that. What's much more interesting is what will happen if Biden comes into place. And I think there it's very clear that there's going to be a very significant boon in renewables and infrastructure. I mean, these infrastructure plans are obviously much greater than what the Republicans have put forward. And obviously the important component of this is that we need a Democratic sweep for this to actually occur, right? For Biden to be able to fully implement the plans. So renewables, infrastructure, and very, I mean, maybe something that's a hot debate, but you know, the decriminalization of marijuana is going to be high up on the agenda, and I think that's really quite interesting. And also banks, which have not been allowed, I suppose, to work with marijuana companies, you know, those rules will also start to become a lot more relaxed. On the negative side of the ledger, the Democrats come in, it will be potentially very negative for prescription prices. I mean, our view is that if you come up with a novel, innovative drug, you're still going to get pricing power, right? I mean, that's what innovation is all about. So I still think you can make money, but broadly speaking, the prescription area could be under pressure. And finally, energy companies, you know, if it's pro-renewables, obviously it's going to be very negative on energy. So anyway, those are some of our thoughts. And you know, because we're investing in megatrends, you know, we'd see little impact on our portfolio. But nevertheless, policy making is a megatrend. It can impact different trends. And one of the
that's absolutely right. You're right.
Yes.
The policy is going to be sort of an overriding concern. So with that, Francyne, let's turn that question over to you. How is Franklin thinking about this?
I think, you know, from our point of view, we're really sort of bottom-up stock pickers. And so again, you know, we pay attention to, you know, the geopolitical and the macro environment. However, you know, our decisions are broadly driven by, you know, the stock fundamentals and, you know, in terms of the environment in which the companies play. So a lot of our names are supported by secular growth drivers, which I think, you know, protects it from, I guess, the volatility. There will be volatility, I think, you know, from a political and worldview. I think the key risk in the near term to next week is basically a non-result on the day, and counting dragged out as in 2000 and what that may entail. And as Monik said, you know, obviously the polls are pointing to Biden, and potentially a blue sweep, but it's difficult to say given the experience that we've had in 2016. There are other data points like, voter registration in key swing states suggests that the Republicans are coming out more than the Democrats. So it is a very difficult sort of, environment over the next, week or so, and a lot of uncertainty. But I think what is clear in terms of markets is that a Republican win is probably better given the potential for increasing corporate tax rates. So Biden wants to increase it to 28% from 21%, which obviously I think, if he does win is one of those things that companies will have to contend with. But, there is uncertainty regarding regulation, although it would be, regulation would appear to be more onerous under Biden. So I think, again, we're bottom up, and as Monik said, there's implications for the energy companies. We don't hold any sort of energy companies in our portfolio. We don't have any infrastructure, because typically they don't sort of they're not sort of high growth sectors for us, and so we don't invest in those sectors. The only one that would be of interest to us is in terms of healthcare, and we do own Humana, which is a managed healthcare company in the States, which we're watching closely in terms of the developments there, in terms of the impact to the costs of healthcare and how that sort of plays out. But I think from our point of view, these things happen in terms of, volatility in markets, and, we are sort of watching it on a stock by stock basis and trying to manage through that.
That's great, Francyne. I think that's pretty clear. We just got a quick question here. I'll just jump in and answer it. All the betting shops are pointing towards Biden too. I just flagged to everybody that we're all watching the same numbers, and yes, the betting shops are pointing that way, but it's not as if they're very strong odds. It's directionally in his favor, but it doesn't necessarily mean it's a landslide. So I just be careful about drawing conclusions from polls and the betting shops. So with that, let's just jump into the second question here. And this is something that's sort of coming out of Morgan Stanley research as well, is that we've sort of started talking about this idea of the world moving away from a Washington consensus. This idea that the world is no longer sort of focused or rotating around what America is doing or leading with. And so with that view, we're moving towards what I would call a more of a multipolar world, where you're seeing a big change in globalization patterns. So with those changes, first of all, I'll go to Francyne, to you first. What do you think are some of those opportunities from those changes in globalization patterns?
I mean, I think from an investment point of view, the US is still the deepest and most liquid market in the world. And traditionally, there's been a lot of innovation in the US market. There remains, I think, from our point of view, a lot of opportunities there. And we've seen a lot of, good and strong US companies, provide a lot of innovation, over the last couple of years and going forward. However, there has been a shift, over the last couple of years with the emergence of China as a key player. And I think this so far has been driven largely by the access of, international companies to the emerging Chinese consumer, as well as also in technology. So from an innovation point of view, clearly, the e-commerce iterations and certainly, the developments there have been interesting, but to some extent unique to its home market. There are other sort of emerging sort of plays out there as well, in terms of India and Indonesia as markets that could prove to be interesting and worth keeping an eye on, especially given its young demographic and emerging, wealth in the population. But I think, implications for the markets themselves are slow to change. So for us, we're driven by the bottom up, merits of companies based on whether or not the business models are sustainable over the long term. So we're looking for companies with strong competitive advantage, strong corporate governance, which is supported by valuation. So we continue to look for companies which, have strong free cash flow generation and the ability to reinvest those free cash flows into sustainable growth. So for example, we like companies such as Mercado Libre, which is in a Latin American e-commerce play, which will benefit from the penetration of e-commerce, in the LATAM region. And that's sort of divorced from the multipolar view that people might have. And so, I think, from that point of view, yes, we understand the sort of geopolitical movements there, and maybe, you know, globalization shifts, and, you know, maybe supply chains need to sort of come into full view for companies as we sort of go through this next phase. But I think by and large, we're still looking at it on a stock by stock basis, and, you know, it is slow to change. The US currency is still the key currency out there, despite efforts to sort of increasing efforts now to internationalize the you know, the yuan.
Yeah, that makes a lot of sense. So basically what you're saying is that you're still very much focused on stock picking. You are aware of what's happening globally, and you don't swim against the tides, but you just try to navigate them as best you can. So I'll flip that over now to Monik. What are your thoughts around how you're navigating this environment?
Look, I would concur with some of the comments that Francyne made. I mean, we often, when we think about the biggest emerging market in the world, we always say it's the United States. And people sort of scratch their head and go, what are you going on about? And we say, well, because of the tremendous amount of innovation across the broadest spread of sectors. And when we're looking at long-term sustainable megatrends and looking for, as Francyne said, corporate governance and very high levels of profitability. And that's really important because you can buy into megatrends with very little profits. And our focus is very much on the most intensely profitable companies. The US is still the #1 place for us to go to. So very, very important, but we are seeking to benefit from trends occurring in other parts of the world, but by investing in companies that have got the governance, the innovation, and they can leverage into those markets. So that's the way we're sort of thinking about those things. Now, the sort of on a broader issue, which I think is probably a bit beyond what we do specifically, because we're very focused on those innovative companies. I think emerging markets are going to become much more important because they're going to be the economic driving forces of the future. You know, the demographics clearly support that. And, you know, investors are generally very underinvested because, you know, I think the MSCI has got something like, not that we follow the MSCI benchmark slavishly, but it's got something like 12 or 15% exposed to emerging markets. Whereas if you look at their contribution to global GDP growth, it's 40%, right? So that has to change. So I think investors will need to start thinking about emerging markets as a more important component, but be a little bit more smarter about it. I mean, just by investing in an emerging market fund doesn't really give you the exposure you should be looking to generate strong returns going forward. So, you know, for us, every country is going to have its positives and negatives. And for example, you know, one that we think has got tremendous opportunities going forward is India. A very strong demographics, strong, you know, young working population coming through, high consuming society, a bit like the US. So it's got very strong tailwinds. So I think to get exposure there, you need to be very specific and tailored. And I think a single focus exposure to India or buying companies, perhaps in the US that are like Domino's, which we'll talk about a bit later, that's got very strong exposure, you know, to the Indian consumer market. Pizzas are growing very strongly. You know, the Indians love their pizzas and seeing huge growth. I think that's the way to get exposure there.
That makes a lot of sense. Hey, let's face it, everybody loves pizza. I think that number you mentioned, 15% of EM is an MSCI weight, but it's actually 40% of global GDP is something that a lot of people aren't really sort of attuned to. So that's a good point. Touching on that, why don't we continue on that line of thought? The reason why there's that disconnect is because of China. Like China is a big chunk of the world economy. Given their sort of geopolitical ambitions, what do you think this means for markets, and how are you guys dealing with the rise of China? Monik, I'll go with you first.
All right. Okay. So from our perspective, China actually, you know, obviously we've seen a tremendous transformation over a number of decades now, but we think they're facing some significant headwinds here. You know, the centralization of power that the Chinese government have taken is really creating or undermining, I think, the entrepreneurial aspects of what's been achieved up to date now and the progress that we've seen. So that to us is a bit of a concern going forward. They've got an income inequality issue, one of the widest actually around the world between the rich and poor. And that's something that needs to be addressed. And it's a difficult time to address it. We've just come out of COVID and, you know, that's going to be a challenge for them. And since the global financial crisis, really the export engine, the low wages, the competitive labor force has really been turning against them. I mean, China's got an aging demographic and and they're not as competitive anymore. So I think a lot of the tailwinds that were there for China are now starting to turn into headwinds there. So so what it means for us is that, you know, I think again, as I mentioned in our previous discussion on previous point, I think just buying a broad-based a manager that has a high exposure to China is quite a dangerous way to invest. And really, you need to be very specific in terms of working out what are the competitive advantages of the sectors in the Chinese economy or any other emerging market, and really look for very select ways of investing. That would be my take on it.
That makes a lot of sense. And Francyne, how's Franklin dealing with China or thinking about China in your portfolios?
I think there are many interesting companies in China. I think the issues that we've had with, you know, some of them has been in corporate governance. So, for example, you know, we found it very difficult to invest in banks given regulations on both the deposit and lending sides of the equation. And we look very closely at the rights of, you know, at our rights as shareholders, and judge these opportunities on a stock-by-stock basis. I guess we've seen a lot of talk about, you know, trade wars manifest, you know, over the last couple of years, and certainly it appears to be a bipartisan issue in the US. The commentary in Australia has also changed in recent times. And I think companies are now looking more at their supply chains and trying to better understand the flexibility of those. However, you know, this is going to take some time to unwind, particularly for pharmaceuticals and tech components. So again, we'll look at, you know, each company on their own merits to consider how this will impact business. I think the opportunity has been there, you know, for a lot of companies, international companies, in terms of tapping into the Chinese consumer as an opportunity for growth around the world. The question going forward, I think, is whether or not there'll be a wider opening of the Chinese economy, and whether this is a necessary condition for them to becoming, you know, a global dominant superpower. Obviously, you know, they are there, but whether or not, you know, the opening up of the economy happens is something that needs to sort of put them on equal footing, I guess, from that point of view with the US in many ways. You know, they've been looking at the internationalization of the yuan, but this will take time. And to date, the use of the yuan is as a payment settlement currency still lags far behind the US dollar. So overall, we're watching the developments carefully. We'll make a decision on a stock-by-stock basis. The US is still the most liquid and open market, and investors, I think, will go where they feel they have good access and where there is stability in markets.
Yeah, that makes a lot of sense. I think both of you are being very sensible. It is increasingly becoming a stock picker's market, and micro factors is not simply buy the exposure. There is just a lot of undercurrents that you need to be aware of. So with that, look, let's jump on to the next question here. And this is really about the legacy of quantitative easing and the implications it has for inflation longer term. I know, Monik, you've got a specific slide that you wanted to speak to. So why don't we start with you first? What are your thoughts about what's happened with QE?
Yeah, so I think there's been a lot of focus on QE and managing the yield curve, and that's what's actually suppressing expectations going forward. But what this chart shows is what have been the expectations over time about inflation on a 5-year look-forward basis, and you can still see that it sits below that 2% level that the Fed's been focused on for such a long period of time. And I think the market's got a bit too fixated with the impact of QE and have really missed out on, in our opinion, understanding what's really been driving sort of the deflationary aspects of the world economy. And we think there have been a number of factors. It's quite a complex subject, but probably two big ones. One is demographics, and demographics do matter. And if you look at the UN's expectations of the aging population, you know, they're expecting that by 2050, 1 in 6 people will be over 65 versus 1 in 11 today. Okay, so that's quite a big move. Now, if you look at Japan and seen what impact that's actually had in Japan over time, and Japan at one time had a very high savings ratio, and there was a big debate, I remember, about that in the late 90s. And through this entire last 20 plus years I've been monitoring it, there's been very little signs of inflation coming through. So there is what we call a very strong linkage between old age dependency and inflation. And we're seeing many other developed markets that are aging and are moving slowly in the direction of Japan. The other big one that's been deflationary has been technology, and that doesn't get picked up very easily. Now, Adobe do a very interesting price index. It's called the Digital Price Index. And what it actually shows is that online deflation is significantly outpacing deflation at large. So, you know, if you look at examples such as electronics, we've seen a 44% decline in the prices of electronics over the last sort of 5 years. Home and gardens are down 30% online, and groceries have basically been flat. And they're three of the largest components in the technology space. So, and there's been other related areas. I'll just finish it off here. You know, you've got the sharing economy, where, you know, companies like Airbnb and Uber are using a lot of underutilized capacity there and bringing that to the market. And that's also depressed the overall inflation rate. So I think there have been some very powerful forces in place that are depressing inflation today. Those trends continue to be in place. And that's why we believe the forecasts continue to suggest low inflation for an extended period of time, Nathan.
All right, so low inflation for the foreseeable future, well below that sort of long-term 2.5% trend that we saw in your chart. And Francyne, from your perspective, how is Franklin dealing with the aftermath of the enormous amount of QE that has happened over the last few years?
I think I would echo what Monik says in terms of inflation. We haven't seen it, and you know, I think, you know, higher interest rates potentially, you know, be pushed out, you know, 2022, 2023 story. You know, I think, you know, QE has been effective, no doubt, in terms of improving the macroeconomic conditions at the time that it's been needed. And we've continued to see the support, you know, during this COVID period. But, you know, inflation, we haven't really seen it yet. It's not something that we're sort of, you know, concerned about in the sort of near term, certainly. And I would say, you know, with the other factors that Monik sort of pointed out, you know, there has been sort of export sort of deflation. You know, the outsourcing to China and other sort of emerging markets has sort of kept, you know, product prices low. I think, you know, if you're going to see inflation anywhere, it might be in, you know, the services side of the business, you know, in the business sectors. But I think, you know, we're not sort of seeing it as a key risk over the next sort of little while. So it's something we're watching, but not sort of a key risk in the near term.
Yeah, that's probably a good point. And I think both of you are sort of pointing to this low inflation environment. So the companion with low inflation, of course, is a general low interest rate environment. So Monik, I'll go to you first. Lower for longer rates, what does that mean for portfolios?
Yes, I mean, that's a real challenge, I think, for most, I mean, we're obviously equity specialists here, but, you know, for most asset allocators out there, because, you know, to try and generate a return that's going to maintain the living standards as people get older is going to become an increasing challenge. So what it's doing is obviously forcing them up the risk curve. And, you know, there are some opportunities there, clearly, but it also means that if you're not careful in that stretch for yield, you're actually going to end up destroying your returns. So it is a very difficult period. Certainly from our opinion, from our perspective, I think we feel, and certainly my experience in doing this for a long time, that equities will have to play a bigger role in portfolios to deliver the return. You know, dividend yields has also been a challenge. A lot of high yielding companies have cut their dividends for lots of reasons, the economy, disruption. So really total return is the way to go. That means more volatility, unfortunately. You just can't get away from that. So investors need to get trained and appreciate that, look, you know, it's nice to have steady and low volatility, but if you want the returns, you've just got to tolerate higher levels of volatility. And really, I think the way, because we've had disruption impacting so many sectors, it is a stock pickers market in our view now, very, very clearly, more so than at any time in the future. So really quality, sustainable growth assets, high levels of profitability. You know, obviously valuation is always going to be important, but in a low interest rate environment, we know that you can pay more for a stream of attractive cash flows. So I think that's my takeaway. You know, is more equities, accept more volatility, stick to quality. You still need to have some defense. Bonds will always have an important role to play. It's not only about returns, but it's about creating stability. That came through again this year. Everyone's saying get rid of government bonds. we don't know where yields are going to end up. They've been negative in Europe, right? I'm just saying they can go lower. And every time the market falls, the bonds are stable, okay? And it's provided a buffer. So don't dismiss government bonds either. So that's my conclusion.
Yeah,
there.
no, that's some solid advice. It's very similar to what we're saying to our clients as well. It's you have to maintain diversification. Government bonds still provide you that backstop. Look, I'm just watching the time, and with all these sort of things, they always go a lot faster than expected. So I think we're just going to jump into the last bit. I want each of you to have an opportunity to really showcase some of your best ideas. So Francyne, I'm going to lead with you first. Given everything that we sort of spoken about today, what are sort of your best ideas in terms of how to position your portfolio, perhaps some direct stock ideas?
Sure. So you flip to the Shopify slide. I think Shopify is a company that is sort of an anti-Amazon play in e-commerce. It's a great company in that we believe that while brick and mortar retailers have been late to the e-commerce game, the larger players or the larger retailers have had the resources to invest in an online presence. And I think the SMEs have been left behind, and Shopify has been able to help them bridge that gap. It started off as a simple plug and play option to gain an online presence. We see it as an anti-Amazon play, as at its core offering, it allows the SMEs to retain their own branding and helps them engage with their customers to drive repeat purchases. So slowly, I think the business has morphed into providing a full offering of helping businesses manage their inventory, if they've got a bricks and mortar presence, to help them plug into that, help them with social media promotions and marketing, payments, and now increasingly fulfillment. So as the business has grown, it has started to expand its total addressable market from providing services initially to the SMEs to now larger enterprises. It's grown its merchant base and also its take rates, and we continue to believe that this company can continue to gain market share as it further penetrates the e-commerce market and expands into other revenue streams over time. So I think, it's an e-commerce play that is, an anti-Amazon e-commerce play that over time will sort of gain in terms of, gain more traction in terms of their merchants, and ultimately will be able to sort of increase and flex their revenue streams. So it's a company that we like in the portfolio.
And Monik, what's your sort of best idea right now?
Well, as I said, we have a number of really attractive ideas, and as I said, importantly up front, a lot of them are not in the tech space, they're out of the tech space, so they provide the diversification. And I think what Francyne touched on at the beginning, low correlation with other managers is important, other strategies, and I think that's really important when you're building a portfolio, whether you're building a portfolio for yourself or across different fund managers. But one of the more attractive ideas we have, and we have a number obviously that we're excited about, is the food away from home market. And if you look at the size of the market, if you look at the left-hand side of the chart, that's actually surpassed the food prepared at home market in 2012. And there have really been three key drivers behind that. There's been obviously the greater shift, let's see what happens going forward, but greater shift towards urbanization, the increasing number of women in the workforce, and obviously the demographic shift to millennials. So if you look at this year, the forecasts were that the millennial spend in total will exceed that of the Gen X's. So they're really becoming very, very important to understand in terms of the consumer buying, habits. So a major beneficiary of that trend is Domino's, an insanely profitable business. They can almost double their stores over the next 10 years. If you look at McDonald's, it's stagnant. They've had no revenue growth. Domino's same-store sales has been growing very, very strongly. In fact, in the post-COVID period, because they're so digitally orientated in a physical world, okay? So, talk about bricks and mortar, and here's a bricks and mortar company that is so strongly digitally enabled. Their sales growth on a like-for-like basis, has been increasing at double digits post-COVID over certain months. So, we've had a GDP disaster, and here's a company that's delivering double-digit growth, okay? So digitally enabled, very high levels of profitability, incredibly strong tailwinds in terms of the shifts, as we've shown in these charts here, and strong growth globally. I mean, I spoke about India a bit earlier, so they've got strong global growth, not only in the US, where they're underpenetrated, but in important growing markets like India.
Very good, Monik. Let's take a look at Francyne, your next idea.
Yeah, so I don't want to give the impression that we're just all tech stocks. You know, our stock holdings, you know, across the SMA and also in terms of the fund is fairly diversified across, you know, the different sectors. What we're really trying to do is to find the best names with each of those sectors, which have good secular growth support. So one of the other names that we hold and that we like is Intuitive Surgical. Which is a company, a medical device company that makes the Da Vinci surgical systems. So the thesis here is that we believe that robotic surgeries will increase in penetration rates over time. So it has many benefits, including, you know, lower blood loss, better recovery times, shorter hospital stays, etc., which has been, you know, a positive and will continue to be a positive in terms of keeping healthcare costs down. We've definitely seen a shift from laparoscopic surgeries to robotic surgeries, and urology has seen the best progress so far. But we are starting to see more of this shift in gynecology and also in the use of, you know, general surgery. So the growth opportunity really lies in further penetrations of these other types of surgeries, the training of surgeons to use the systems, and, you know, as they come through, the expansion also into international markets. So while COVID has seen elective surgeries drop off, you know, we've basically taken the opportunity to build up on this position, and we continue to believe that it remains, you know, a good, solid, long-term key sort of portfolio holding for us.
Very good. Back to you, Monik. What you got for us?
Okay, so the pet humanization megatrend. So here's a very resilient trend. Okay, it keeps on growing at the same rate regardless of what the economic cycle is doing. So tremendous. We have two stocks exposed to this trend. We've mentioned the company of Zoetis, and you know what's fabulous about pets is it's age agnostic now. Okay, so older people are treating pets like humans, and so are the younger, you know, the younger cohort. So, you know, we've got growth coming from both areas. The industry's been growing at around 6% per annum since 2013, and if anything, what COVID has done is actually accelerate that trend. So in Australia, the amount of money spent on pets has actually increased, you know, post-COVID to over 20%. Okay, so that's obviously not sustainable, but it just shows you that, you know, as we're all now looking for, you know, we're all locked up at home or we're all being restricted, you know, human nature is such that we want to be in contact with people. We need love and affection, and pets are an important component of that. So we see very strong underlying growth rates in that. And Zoetis is a stock we've held for a number of years in the portfolio, and they're the leading providers of vaccinations and medications to the pet and animal health industry. You know, large spread of countries they're exposed to, large number of products, and the amount that individuals spend on medications is growing at a faster rate than what humans spend on prescription drugs. So tremendous tailwinds, very, very attractive company, very resilient and highly profitable.
Very good.
And I guess our last key stock idea for today is CoStar Group. It's basically a data and analytics provider of information in the US commercial real estate sector. So it's a platform which is well positioned from the digitization of commercial real estate in the US. Commercial real estate transactions have traditionally been fairly labor intensive, with a lack of visibility in terms of market information, such as, you know, vacancy rates, transactions, how these buildings are financed, sales comps and rental yields. So, and CoStar, through its 30-year data history, is helping to better enable transparency and information in the sector. And this should continue to position it well going forward. So throughout the COVID period, we're starting to see a fallout in the real estate sector, especially in light of retail office space. And as some of these distressed assets come to market, buyers and sellers will need to draw upon CoStar's data. So where there's been increased rental stock coming to the market, CoStar clients have also upgraded their subscriptions in order to better position their properties on the platform. So I believe that the stock has seen good resilience in terms of the company revenues, and we expect CoStar to be a long-term winner and continue to like the story.
Very good. I'm taking a look at some questions here, and I think the one I'm going to ask you, Francyne, for this one, it's about what we're seeing in terms of this looks like a second wave starting to manifest around COVID and the potential impact on supply chain pressures. You guys are very much bottom up. Are you seeing or thinking about the ramifications of perhaps a return to hard lockdown and what that means for global supply chains?
I mean, I think it's difficult. Obviously, in Europe, it seems to be that they're going down, the lockdown route, whereas I think in the US, it will be probably less so, but I guess that depends on who wins next week as well. But I think at the moment, and from the company sort of reporting season that we've seen thus far, it seems to be that companies are still fairly cautious in terms of the outlook, but certainly things have been on the recovery, and it's something that we remain watchful of. But I think by and large, the companies that that we hold in the portfolio seem to be sort of managing through their process, through this process. I think what they've done is they've managed to sort of cut costs. The issues when COVID first started in terms of shoring up balance sheets and liquidity and things like that, they have been done. Whether or not there's a second go around with that as we sort of head into the new year, remains to be seen. We're certainly monitoring that, but I think a hard lockdown is not on the cards. I think in terms of economies, we should be in a better position to sort of manage through this. And there are sort of therapeutics out there that can help sort of alleviate some stress on hospital systems and things like that.
And Monik, is there anything that you want to add to that?
Not really. I suppose one important takeaway is that ultimately we will get through this period, and companies that were very strong as we went into the lockdown, the strongest companies will actually end up being even stronger once we come out of the scenario that we are all are in the process of going through at the moment. So there are some companies that have been temporarily impacted in terms of the earnings and cash flows, but because they've got incredibly strong balance sheet strength, and they really are the number one player in terms of market share, leadership, and innovation, even those businesses, when things recover, they will actually perform much more strongly post-COVID. So, a good example there would be Disney. And I won't go into Disney to great length, but they've obviously been impacted in terms of theaters and entertainment. But if you look at the strength of the franchise there, the balance sheet, just the IP, the content, the most valuable content in the world, once we get through this COVID period, they will be in an even stronger position once we come out of it, and a much more valuable business.
That's great. Look, I think we're getting pretty close to full time here. If I could just take a minute here just to summarize, to sort of paraphrase what you guys have been sort of speaking about, I guess the takeaways that we have for investors today is, one, you need to sift through all that data and all that noise, and you still need to apply judgment. Number two, demographics and technology. These things are not going away. These are trends that you're going to need to deal with. Number three, when you're looking at companies, look for strong free cash flow, and importantly, look for governance. I think strong corporate governance is becoming a real highlight going forward. And one thing I really did appreciate from both your approaches was around diversification across sectors and themes to help manage risk, which I think is most important. And just sort of as a small plug for Morgan Stanley, active management. I think this is what another key theme here is that at my firm, we're very much agnostic between active and passive strategies. We think there's a time and a place for both. I think our view increasingly is that the pendulum is starting to swing the other way, that there is now a time to start reconsidering an active allocation within your portfolios. You should have a framework that thinks about that, and that's something that we help our clients with in terms of finding that right balance between using passive where it's appropriate and using active where it's appropriate. So I just want to say thank you very much to Francyne and to Monik. You've given us a lot to think about, and to Toby and for IMAP for hosting this event and bringing us all together. So with that, I think I'm going to wrap it up. And oh yeah, sorry, one more last thing. Just a shout out, on Friday, we're going to have the third part of our international series. I'll be hosting again. We're going to have 3 PMs that are going to go even deeper into specific stock ideas. So join us then Friday, 12 o'clock. Until then, talk soon, stay safe.
Thank you very much, Nathan. It's been a pleasure for us to host this. And Nathan, thank you, Francyne and Monik, for your sessions today. As Nathan said, next Friday, 3 PMs talking about their ideas. Monik's point about pet humanization really resonated with me. Meloxicam is a widely used drug for anti-inflammatories, used by people who have arthritis and such like, also used by pets with arthritis. It's 100 times more expensive from the vet than it is on the PBS. So there's plenty of margins in those pets. So thanks very much for joining us today, and we look forward to you joining us again on Friday. Thanks.
Thank you.
Thank you. See you then.
Bye.